Hi, I'm Dan Loney from Loney Financial Corporation, and thank you for joining us today on Your Money Matters. Today we're going to be talking about a question in context of Canadian savings and retirement. Question that we often get asked is RRSP versus TFSA. Well, what that means is Registered Retirement Savings Program or a tax-free savings account. In Canada, we have two different major opportunities to save with tax deferment and tax treatment, and Registered Retirement Savings Program has been the most common since the 1960s. With the RSP program, the current legislation is that we are allowed approximately 18% per year towards our RSP program. Now, if you made $100,000 a year, you're eligible to put $18,000 into your RRSP. If you didn't use that last year, then you can carry forward to successive years. So it does have a system of accumulation, and what you'd want to do is use this according to your ability to save, and also there's an opportunity to do some tax planning in there as well. In an RRSP, your tax is deferred to a later date when you take the money out of the RRSP, and that allows for accumulation and growth. And the way that that happens is when you go to take the money out of your RRSP, you can do so, but there are some withholding charges and things that we'll talk about later. But with an RRSP, the idea is to save long-term for retirement. And at age 71, you must convert your RRSP into a Registered Retirement Income Fund, a RRIF program. And the RRIF program will then give you a schedule where the money is squeezed out into income, and you'll be taking that out every year. And that does increase year by year as you get older. Now, you have different investments that you can invest in. Many people have asked me over the years, Dan, I want to buy an RSP. And that is somewhat like saying, well, I want to buy a car. What kind of car do you want to buy? You know, are you going to go skiing at Whistler, BC with it? Or are you going to be driving to Alaska, or you are going to want an open highway roadster? Different cars for different situations. In RSPs, there's many investment sectors that you can invest in. For example, you could buy a stock, and then you could register that stock if it's compliant with CRA legislation, Canadian company, and the other criteria that they have. You could buy that stock and then register it as an RRSP. Another thing that you could do is buy a mutual fund, investment fund. You could buy different types of products that are eligible, real estate, limited partnerships, all kinds of different investments as long as they are CRA eligible. And so those are some of the advantages. You can deposit into RRSP. If you had a $100,000 income and your RSP contribution was $20,000, and you had that in your carry forward, then that would allow you to receive a taxable tax refund, a sizable tax refund, according to whatever income tax bracket you are in at that time. The TFSA was introduced just a few years ago, stands for Tax-Free Savings Account. And the TFSA is to encourage people in Canada to save money, and you're given an allotment of $5,000 a year that you can invest to your TFSA. It also does carry forward as well. And the difference about a TFSA as opposed to an RRSP is that the growth of that money is not taxed like an RSP, but you do not get a tax deduction for it. So if you were to put $5,000 into a TFSA, you would not get any money back in your taxes for that contribution to the TFSA. However, you would also not have to declare the growth of that money. And when you sold that TFSA and withdrew money from the TFSA, you are not going to have to pay tax on it like an RRSP. When you receive money from an RRSP, it's going to be taxed and there's going to be withholdings, but with the TFSA it's different. And we'll get into some of the disadvantages and advantages of the two different types of programs. As speaking about the withdrawals, there is a withholding tax on the RRSP. And that withholding tax starts at 10% for under $5,000 and will go as high as 30%. So if you're going to take $4,000 from your RRSP, then CRA, Canada Revenue Agency, is going to withhold $400. And that schedule goes right on up to 30%, so that if you were taking out $100,000 out of your RRSP, they would withhold $30,000 from that withdrawal, so that that money goes to handling your taxes at the end of the year. They have decided to collect it now rather than trying to chase you and collect it later. Now, what happens if that's too much or too little? Well, when you do your tax return, they will assess how much money you owe, and if you've overpaid, they'll refund it to you. And if you haven't paid enough tax, then they'll come back and asking for more in that situation. You may, on a $100,000 withdrawal, have a $30,000 withholding, but that may not be enough at the end of the day. The highest tax bracket is around 43%, and they might be looking for a total of $43,000 in taxes, and you might have to pay an additional $13,000 at year end when you're doing your taxes. With the TFSA, it's different. You can take the money out of the TFSA, and there is no withholding on the taxes. So TFSA allows you to save money for short-term or long-term goals and accumulate that money without having to declare the accumulation and without having to declare the growth in that money as well, because you're not taxed on it. And there will be some real advantages that we'll talk about that in a moment or two. So comparisons. Well, let's compare, what does this look like over the long term? Let's say $4,000 over 40 years, so someone at 30 years old putting in $4,000 a year. We're going to have a growth rate of 5%, and let's say this person is in the 40% tax bracket. So those are our variables. The RSP in the 40th year is going to have $451,000 that you would have cash in hand after paying back the taxes and taking that money out. The TFSA is going to have $536,000 in cash in hand. Now, I must point out that in this example, we did use the tax return that we got on the RSPs and put that back into the program. But as you can see, that the real difference is the taxation of the money at the end of the day. We've got the same contribution amounts, we've got the same taxation level, the same growth rate, but it's the tax that is taken off when you take it into income as an RSP is where the difference really is at the end of the day. So the TFSA is going to be $536,000, and you're going to have significantly more money at that time. But that doesn't mean that the TFSA may be the right product for you in this situation. Let's look at some differences and some considerations about what product you would use in which situations. Well, the RRSP provides tax deferral. So it's not tax-free. You will be paying tax on the program. But that tax is being deferred out to a year sometime in the future. You also have the option then to take the money out at an income and a tax rate less than what you're earning today. So you might be in the 40% tax bracket today, but when you take that money out, you may be able to structure the withdrawal so that you're in the 20% tax bracket. And that's how you would begin to minimize the tax implications of the taxation of the program for the RRSP. There's different things you can do with income splitting and spousal RRSP and all of that you want to talk to an experienced advisor in setting up your own program how to do that. Well, the TFSA is great in one scenario. I've seen it used by clients and friends, is that sometimes purchasing a stock that's eligible for TFSA. I have one friend who's purchased amount of stock, approximately $30,000 of stock that grew to about $250,000. Well, when they take that money out, don't have to pay any capital gains. They don't have to pay any income from that. That is all their money, and that is a huge advantage in using the TFSAs for a stock account. So that's one thing you might think about if you're going to buy stock and you're going to have some play money. If you're not a professional investor, take that money, invest it in a TFSA, so that if you do have what we call a 10 bag or a 100 bag or a big win, that you're not going to have to pay capital gains on that money when you realize the profits from that investment. So those are some of the examples and some of the things that you can do. One thing about dates is RSPs are always held to a date. Generally, it's March 1st, but in a leap year, this year as we speak, it would be February 29th for the RSP. For the TFSA, it is calendar year end, so that $5,000 allotment starts every January 1st that you can put that money in. And keep in mind that $5,000 does carry forward in that respect. Well, prescription. There's a saying that I've used for years and years that prescription without diagnosis can be malpractice. So you want to make sure that you consult your tax professional, because your tax professional is preparing your taxes and giving you advice, and they may be doing something that would implicate your tax planning. So always consult your tax professional, your accountant, whoever that person may be, is helping you with that area. And as with RSPs and TFSAs, I think for most Canadians, they both have a place. They both should form part of the strategy for our savings and what we can use them for. So we have some questions that have come online, and let's look at these now. Mark from Vancouver is asking, we hear all these terms which I find very confusing, like RRSP, RESP, RIF, and now IRA, TFSA. Could you maybe explain what these are? Absolutely, Mark. Good question. Well, these are all acronyms for different products that are available, and RSP is Retired Registered Savings Program. I should say Registered Retirement Savings Program would be more accurate. And then RESP is for Registered Education Savings Plan, and that's a plan by where most of the time parents are saving for their children, and there is a government grant of 20%. There's criteria and stipulations, but it's a way to get a bonus where the government does kick in to help for education savings for children in Canada. The RRIF is Registered Retirement Income Fund. This is when you convert an RSP and start taking income. You must do that no later than age 71. And the IRA is a term that often comes up in media because it's a U.S. term. And it would be the equivalent of, although it doesn't work exactly the same, but it is the American version in the United States of a retirement program. TFSA is tax-free savings account. And there are all kinds of different, there's LIRA, L-I-R-A, Life Income Retirement Account, many different types of things. So great way to find, if you don't know something, is just email us. We'll be happy to give you the answer. You can also use Google as well, to Google, and our email's on the side here. You can just use that. All right, from Seattle, one of our American viewers, George writes, I live in the USA. Now, do all of these terms apply to me? Can I use this, or are they only in Canada? Well, these are Canadian terms, George, and as I mentioned, you do have an IRA in the United States, and there are different things that are set up in the U.S., a 401k, and there again you get into all your different terms and different things that are provided for the Americans. But it's important that anytime you look at a financial concept, that you speak with an advisor that is totally experienced in dealing with the financial regulations in your jurisdiction whether it be the United States or Canada, if we have any listeners in Australia or the United Kingdom, it's important that you're working with an advisor that understands what the rules are in that jurisdiction. Then from Montreal, Quebec, Rosina writes, do I have to register somewhere for a TFSA? Who can do this for me? Well, there again, TFSAs can be used through most major financial institutions, and also financial advisors and consultants can set up a TFSA for you, and then also provide the education and understanding of how the product works and what the uses for the product are. You can also Google TFSA and you will come up with different information on that as well. And feel free to email us if you have any questions. We'd be glad to answer your questions with our answers. And so that ends our questions, and I wanted to leave you with just one tip today when we think about finances and that. One of the amazing secrets, if you will, about money and finance over the years that I've noticed is I've seen two people working at the same job in the same industry for 20, 25 years. And yet one person has a very significant retirement balance and the other has almost nothing. And the reason is the one got involved in a systematic program for putting money away every month, every year after year after year. And as years went by, it built up where they were having a significant retirement account provided for. So the tip is get involved in a program today. Start something. Start putting money away. Put 10 to 20% of your net income away every month for your financial future. Well, thanks for joining us today on Your Money Matters. I'm Dan Loney, and we wish you a great week and a great year. Thank you.
That's it for today's show. We hope you got some useful information that will help you in your day-to-day life. If you have any questions on this week's topic, feel free to contact our guest directly by email, which is shown on the left of your screen. If you have any suggestions for future shows, we'd love to hear from you. So until next time, keep on learning.